You carefully researched that company. You checked the fundamentals. You waited for the right entry time. Yet, you lost money. Why does this keep happening? This is a reality that no financial channel will tell you. The biggest threat to your wealth is not the market. It is not inflation. It is not even bad stocks. It is your own brain. Today, we are going to reveal 5 mindset traps that are quietly destroying stock portfolios in India and provide a precise, practical solution for each. Let's get started. Here is a noteworthy point. The human brain evolved 200,000 years ago to survive in the wild, not to navigate the nifty 50. Back then, if the tribe ran, you ran too. No questions asked. That instinct saved lives. But in the stock market, that same instinct, running when everyone runs, destroys wealth. This is called behavioral finance. The data is clear. The average investor underperforms the market by 1.5% every year, not because of bad stock picks, but because of emotionally driven decisions made by the brain. Over 25 years, that 1.5% gap costs more than 40 lakh rupees on a 10,000 rupee monthly SIP. Here are 5 responsible biases. This video is for educational purposes only and should not be considered financial advice. Now, let's start with the most powerful one. Bias number 1, loss aversion. Speed test. What will you choose? Option A, a guaranteed 5,000 rupees now. Option B, toss a coin. Heads, you win 12,000 rupees. Tails, you win nothing. Most people choose option A. Mathematically, option B has a higher expected value of 6,000 rupees. Why do we make this irrational choice? Your brain perceives the pain of loss as twice as powerful as the pleasure of gain. This was proven by Nobel laureate Daniel Kahneman. He called this loss aversion. Let's see how this destroys your investment portfolio. Your nifty mid-cap fund falls 18% in a month. Your brain flashes a warning. Risk. Sell everything now. You sell. In the next 8 months, the market rises 35% again. You have permanently locked in an unnecessary loss. Which of these 5 biases do you think affects you the most? Put a number in the comments. 1, 2, 3, 4, or 5. I will read each one. Okay, let's continue. During the 2020 COVID crash, 62% of retail investors did exactly this. Those who stayed invested, they recovered 100% in just 18 months. The solution is simple. Don't check your investment portfolio daily. I'm serious. When you check too often, every small dip looks like a disaster. Set a rule. Look at your investment only once a month, not once a week. Once a month. Difference number 2. Herd mentality. Let me tell you what happened in 2021. A company called Zomato was listed on the Indian markets. It never made a single rupee of profit. At the same time, its IPO was priced 38 times higher. 38 times. Why? Because everyone was talking about it. My relative earned 80,000 rupees in a week. This is the future of food delivery. Don't miss this opportunity. Millions of people bought it at 130 rupees. In 18 months, the stock fell to 46 rupees, a 65% drop. Here's what your brain did. In the wild, if everyone in the group runs, there is a hunting tiger nearby. Following the herd kept you alive, but in the markets, If everyone runs to buy something, you are mostly buying at the peak. Warren Buffett understood this well. He said, be fearful when others are greedy. Be greedy when others are fearful. The solution: one question. Before buying anything, ask yourself, would I buy this if no one around me was talking about it? If the answer is no, stay away. That is the decision. Bias number 3, anchoring bias. Imagine this. You bought a stock at 800 rupees. Bad news comes out in the sector. It falls to 480 rupees. Your friends say, exit. This is a damaged company. Your analyst says, the fundamentals have changed. But you cannot sell because in your mind, that stock is worth 800 rupees. That is your price. You are enslaved to it. So you hold on, waiting for 800 rupees. It falls to 220 rupees. Now you have lost 72%. All for a number the market does not care about. This is the most powerful truth I can give you about investing. The market does not know how much you paid. It does not matter to it. Your purchase price is completely irrelevant to the market's next move. The important question is this: at today's price, is this company worth buying? If yes, hold it or buy more. If no, sell it, book the loss, and use that capital elsewhere better. Solution: every time you value a stock, mentally erase your purchase price. Value it as if you are seeing it for the first time today. If you do not want to buy it anew, do not hold it. Bias number 4, recency bias. It works in both directions. When Nifty has been rising for 2 consecutive years, your brain concludes, this is normal. Markets always go up. You become more confident. You invest more. You might even borrow to invest. And then a correction comes. And you are completely shocked. On the other hand, if markets have been falling for 3 months, your brain concludes, this will never recover. You stop your SIP, you stop investing altogether. Then you miss the buying phase that would have created a lot of wealth. Recency bias is simple. Your brain assumes that what has recently happened will always happen. But what 26 years of Nifty data shows is that markets operate in cycles: growth, correction, recovery, growth, every time, without fail. Do you see this pattern? The solution: before making any major investment decision, look at the 10-year timeline chart, not the 10-day chart. Your brain needs historical context to overcome the noise of recent events. Bias number 5. This may cause some pain. You made a threefold profit on one stock, then another doubled. Now, your friends have started asking you for advice. A thought arises. I understood this. So, you begin to invest on a large scale. Heavy investment in a few stocks, less diversification, because you believe this will work. Here is a number that will change your perspective. For over 15 years, less than 1% of traders operating in India have consistently outperformed the Nifty 50 index. Less than 1%. Not 10%, not 5%, less than 1%. Professional fund managers, people who do this full time, have not been able to consistently outperform the index over the long term. If you had some successes, some of that was skill, but most of it was market positivity and luck. Luck cannot be accumulated. Solution: keep at least 60% of your investments in index funds or diversified mutual funds. The remaining 40%, that's where you express your confidence. That way, even if your confident picks fail, which sometimes happens, your principal wealth will be protected. Here is the built to hold framework to overcome all 5 biases in 3 simple rules. Rule 1: set up an automatic system. Set up an automatic saving. IP every month. Your emotional brain must be completely detached from the decision. You cannot nervously sell the money that is operating automatically. Rule 2: evaluate quarterly, not daily. Check your portfolio 4 times a year, not 4 times a day. Your investments are like a garden. The plants don't grow faster just because you look at them. Rule 3: do not invest money you will need within 5 years. Once the deadline for the investment arrives, emotions will surge. Only invest money that can be completely forgotten for 5 years. Set up an automatic system. Evaluate quarterly. Think in years. This is the way wealth is created. Before you go, you must be honest with yourself. Loss avoidance, collective mindset, fundamental belief, recent bias, overconfidence. Share your answer in the comments now. There is no judgment here. Every investor, including the world's best investors, has fallen into at least one mistake. The difference is, now you know. That awareness is the first step to creating true, lasting wealth. If this video provided value to you, subscribe to Built to Hold, because next week we are going to talk about the first salary trap, why 90% of young Indians waste their most powerful investment opportunity. Keep investing. Stay consistent. Built to Hold.